Would you like me to? Good afternoon, everyone. Oh, that's come through quite loudly, hasn't it? So, good afternoon. For those who don't know me, I'm Robin Mason. By day, I'm Pro Vice Chancellor International here at Birmingham. By night, I'm still an economist, but I feel a bit of an interloper being here today. But I just wanted to say a few words of welcome to this, the 13th in the series of lectures that we hold in memory of Peter Sinclair. A good number of you in the room, I know, will have known Peter. For those who didn't know Peter personally, you will know him by reputation. If you know anything about Peter, he was a remarkable man who touched many people in many different ways. I first met Peter in the early 90s, I think, which is slightly giving my age away. A man of great intelligence, really wide interests, did interdisciplinary things before interdisciplinarity was the trendy thing to do. But most of all, I think, was incredibly generous in spirit and with his time. And so it's just great that we can continue to remember all of Peter's contributions, not just to economics as a discipline, but to the places where he worked and the people that he encountered, through a lecture series that has had some 12 outstanding speakers already and a 13th truly outstanding speaker that I'll introduce in just a moment. But just before I get there, I just wanted to read out a couple of the things that were said about Peter when, unfortunately, he passed away a few years back. The first from somebody who you may have heard of, David Cameron, the former Prime Minister, but actually it was a really touching thing that he said was, Peter Sinclair was one of the kindest as well as one of the cleverest people that I've ever met. His enthusiasm for economics and solving problems was extraordinary, and he inspired generations of students. It was a complete privilege to know him. And the second thing, just to read out in memory of Peter, is as follows. Peter gave the spark that took so many of us into economics. With undergraduates studying monetary economics in the 1970s, as a colleague at Oxford and later the Bank of England, as the maestro of the RES Easter School, the Royal Economic Society Easter School. I remember going on that myself when I was just a young thing. And at a seminar in Birmingham just last month, Peter was always there for you. That extraordinarily encouraging, smiling presence combined with intellectual curiosity that went far and wide and deep. Oh, how he will be missed. I don't know whether you recognize those words, John, but that's actually something that you wrote. So,
oh, really?
Yes. So I thought it might be quite nice to read what John said in memory of Peter. But that does lead me on to introduce today's lecture, and in particular to introduce Professor Sir John Vickers. John has been Warden of All Souls College at Oxford since October 2008. He needs little introduction, but you know whenever anybody says nobody needs an introduction, you're about to get an introduction. So let me try and be brief because his accolades are many. He studied PPE at Oxford and then after a period working in the oil industry, returned to teach economics and then became Drummond Professor of Political Economy from 1991 to 2008. In that time, he managed to find time to be chief economist at the Bank of England and a member of the Monetary Policy Committee, experience that's going to feature in his talk today. He was then Director General and Chairman of the Office of Fair Trading, 2000 to 2005, President of the Royal Economic Society, Chair of the Independent Commission on Banking, and President of the European Association for Research and Industrial Economics. And I've left out a few things there just for the sake of time. Amongst a number of other things, John led the OFT through one of its biggest changes to become independent from government in 2002, and I think we still benefit, even though the OFT has merged with the Competition Commission, become the CMA. it still benefits from all the work that John did to have something at arm's length from government to look after consumer protection and competition law. He's also remembered as the Warden of All Souls, I hope this is right, John, for scrapping the one-word exam at All Souls. And you can. I read that you still have slight nightmares about the word conversion, which was which was the word that you had to write on when you took that. To his academic contributions, though, if you want to know about privatization in the UK, then you will have read John's book on that, the seminal work. His work then on innovation dynamics, going on also financial systems and crises, more latterly on competition policy, the contours of competition, what to do with consumers with limited awareness, and continues even now to do cutting-edge research that informs both academic thought but also competition law and economic policy. Very few people who have got as wide-ranging a set of research interests and effect on policy as that. And so I thought I would finish by just reading, and excuse me, John, I'm just going to reach right here. Yeah. So you saw this coming.
I did.
Yes. Actually, this is a fascinating book. It's not altogether easy to get hold of, but I recommend it if you can. This is the Palgrave Companion to Oxford Economics. And rather fittingly, I think, the chapter on today's speaker was written by Peter Sinclair. So let me read out, typical Peter, it is a meticulously researched chapter which really does run through John's many, many contributions. But actually, even the opening paragraph is a very nice way to hand the floor over to John. Peter wrote, "Research, teaching, editing, consulting, industry, finance, public service, and university administration are the 8 principal activities that economists may undertake in their professional careers. Many do 2 or 3 of these, sometimes do 1. Just a few at some point or other might end up having done as many as 4 or 5, but very rarely more. At various stages of his life, John Vickers has done all 8, and with real distinction." So we're really fortunate to have somebody of John's stature and experience with us this afternoon. And with that, John, may I hand the floor over to you. Thank you so much for coming to talk to us today about MPC and all matters. John, thank you.
Robin, thank you very much indeed. That rather excessive introduction, but now, Peter. So it's a great honor to be asked to give this talk. And I say that not out of courtesy, but with absolutely heart and soul, because Peter is a very, very important figure in my career, indeed life. So I went for tutorials with Peter. I was at a different college, but I remember going up the wooden stairs in Brasenose College, where he was, at the end of the 70s. And I went for tutorials on a paper then called Money and Banking. And it's odd that in a way, that's what a lot of this talk is about. And every time you got a mug of coffee, and it was the high end of British coffee. It was Nescafe Gold Blend and a chocolate digestive, because hobnobs had not yet been invented. So that happened every time. And I had a very good tutor at my college, but he was more in microeconomics. This was more macroeconomics. And Peter introduced me and my tutorial partner to the wonders of this subject and the sort of Milton Friedman, Lucas, Sargent, and all the rest, and how to think critically about all of those. And he was the greatest of teachers who doesn't teach you things, but he teaches you how to think, which is a much more valuable thing. We were later faculty colleagues. We were later colleagues at the Bank of England, where I was partly responsible for getting him there to head the Centre for Central Banking Studies, where he joined the bank, I think, in the year 2000. He'd already come to Birmingham at that point. And we were just friends. And he was a great traveller. And on his travels, he would write postcards to the children of his colleagues. And there are many, many in this regard. And I got out our envelope the other day of Peter Sinclair postcards. There were 9 of them. Bosnia, Cuba, Manila, and so on. And they're all hilarious in different ways. There was one from Melbourne, which he wrote in an Australian accent. He was quite, and I hope nobody in the Australian Postal Service actually read what was on this card, because it might well have been a diplomatic incident. And I last saw Peter at this university on the 4th of March 2020, when he invited me to give a talk. We met at New Street Station because we were coming from different directions, went round the art gallery, I gave the talk, we went for dinner. And about 2 weeks later, I got the news that he was in intensive care, and he did not survive. So at the end of March, remember the lockdown only began, I think, officially on the 23rd, and he was already in intensive care at that point, and did not survive. And it was David Cameron who led the tributes, as you have heard. Now, I want to talk about the Monetary Policy Committee, which I was on a long time ago, 25 plus years ago. And talk about UK inflation control or loss of control in the period since. I want to begin, I'm sorry, this is maybe a bit of a struggle to see. This is, I think, a nice chart from a recentish paper by Ricardo Rice, which is on English, British, UK inflation going back 800 years, as far as the economic historians can fathom out what was happening to the price level. And on the horizontal axis, it shows that each blob represents 20 years. So there are 40 blobs. And it shows the average inflation rate in each period of 2 decades. And on the vertical axis is how volatile year to year inflation rates were. And what comes out of this is that until basically the 20th century, we in similar economies were on metallic standards like the gold standard, which is actually quite good at avoiding big inflation splurges where the price level would move a lot over an extended period. But it was very, very choppy within period. It all depended on harvests, metal discoveries, and so on. So that vertical dotted line is at 2% inflation rate, as best as can be judged. Most blobs are to the left of that, so below 2% inflation. Over to the right, the high inflation periods, top right is Henry VIII, basically, who famously devalued the coinage because of his fiscal and marital issues. The 3 blobs, lower right-hand side, that's the 20th century from the 1930s onwards, when we had come off the metallic standard, off the gold standard. And the UK, I mean, it didn't have an appalling, we didn't have hyperinflation, but we had a very bad inflation history, particularly in the 70s, we had inflation 20%. That, you know, I was an undergraduate sort of just after that period, but we had more big inflation in the 80s. We were terrible at inflation control. But on the dotted line right at the bottom is the blob representing the first 20 years of independent monetary policy in this country, when the inflation rate was not only 2% on average through that period, but it was amazingly stable by historical terms. And a lot of my talk is going to be about how wonderful it all was 25 years ago and how number of question marks now. I think the truth is we were very lucky, those involved in this area of policy 25 years ago, in all sorts of ways. And the challenges faced by current MPC members and other policymakers are much more difficult. So this is showing, going from the late 80s, this is UK inflation. You'll see that even the end of the 80s, we were up near 10% inflation rate. But then we had this sort of 20-year period just described when inflation was was low single digits and not moving around very much at all. And even with the sort of zigzag periods, I'm hopeless with the pointer, but let me not even try. There are some jaggedy periods around 2008-9, which was the financial crisis. But even then, if you take the 2-year inflation rate, we had sort of like a +4 and then a 0. So if you average through them, we were still very much around the 2% target as it was then. But then, woof, in 2021, the thing started climbing again, and we had this inflation surge, 21 to 23. as happened in many economies, not all economies. The Swiss, for example, didn't experience anything like that. But we had a pretty big inflation spurt. So what was going on? And what I'm going to do is a few recollections, probably through rose-tinted spectacles, on what it was like when I was on the committee at the bank at the turn of the millennium. I'm then going to make a few brief remarks on how this regime, I think, worked very well, even through the financial crisis. But then 2013, that's when Mark Carney has got different job now, when he took over from Mervyn King. I thought there was I'm calling them puzzling developments because I'm not, in my sort of ivory tower, I can't say these were wrong decisions, but there are a number of head-scratching things happened in the late teens. And then we had this inflation surge, and how should we think about that? So what did people look like in 1999 on the committee? That's what we looked like. So in the center at the front is the then Governor Eddie George, the 9 committee members, and then at the back left is Gus O'Donnell, who later went on to be Permanent Secretary at the Treasury and then Cabinet Secretary, who was the Treasury Observer at our meetings. And we met monthly. We had an all-day briefing on a Friday, and then the following Wednesday afternoon we began at 3, discussed what was going on in the economy till 6 or so. Then we had a non-working dinner, and then we met at, I think it was 9:30 in the morning to make the policy decision, which was zapped to the markets at noon on the relevant Thursday. We then had days and days arguing about the minutes, and sometimes once a quarter we published a thing called the inflation report, which came out the week after the policy decision, and which I had overall responsibility for getting drafts to the committee. What were we like? Well, 5 of the 9 were academics or former academics, including Mervyn King, who succeeded Eddie George as governor in 2003. Charles Goodhart, Willem Bouter were the others. We were very argumentative. Anybody who knows, especially, well, Willem and Charles, you couldn't be on a committee with them without an argument, which is, I say that absolutely as praise. And we were pretty hawkish. So I joined the bank in April 98. My first policy meeting was June of that year, which was when the Independent Monetary Policy Committee went onto a statutory basis. Before then, it had been informal from the summer of 97 when Gordon Brown had said, I will leave the interest rate decisions to you, try and hit the inflation target, which then was 2.5% by a different inflation measure from the one we have today. And we, at my first meeting, by an 8-to-1 majority, Deanne was the minority vote, we increased bank rate from 7.25% to 7.5%. Now today, it's 3.75%, and a lot of people seem to think that's high. We went up, even though inflation was lower than today, was ticking along at 2.5%, we went up. And it was a pretty unpopular decision. So why did we do it? It was partly because on our analysis, the underlying inflationary pressures were running at a rate that would exceed the inflation target unless we put a lid on it, because sterling had appreciated, which meant that imported inflation was negative to low, and that effect wasn't going to last forever. And we were also, this was very much early years. We had not established our credibility. Inflation expectations were pretty flaky. Memories of UK inflation being high were like the day before yesterday. So we wanted to get on top of this. And that's why we went up. Another memorable meeting, and this shows how amateurish we were, was the September 99 meeting. In late 98 and early 99, policy eased because of various things in the world economy that called for that. But we tightened again in September 99. And I went into that meeting on the Thursday morning not knowing what decision we would make. There were real debates that we had. They were not pre-cooked. The governor didn't take me on one side beforehand and say, which way are you thinking of going? It was a genuine meeting. And I and some others in the room were surprised that we were going. I think we were right to go up. I was in the 7-2 majority. And it's by then 11 o'clock-ish, and we've got to announce the decision at noon. And Gus O'Donnell, who was perfectly correct, never said anything during the meetings unless there was fiscal information, said, you've got to, how are you going to communicate this? You've got to explain it. So we had prepared nothing by way of explanation. So there was speed drafting to come up with a couple of paragraphs. And that's a very, very high pressure situation because everyone's going to pore over every detail. And we thought we'd got there at about 12:45, and somebody then would have to run through the bank with the bit of paper to have it all retyped in because this was old technology. When Ian Plenderleith, he's the suave person next to the governor, classicist, Christchurch, said, and head of the markets area, said, "Mr. Governor, I'm sorry, we can't possibly say this." And everybody said, "Well, what's the problem, Ian?" He said, in the second sentence, there's a hanging participle. So you couldn't have a grammatical infelicity like that. So we straightened that out and zapped the news out to the market. We learned from that you have to have your communications ready in advance for different eventualities. So that was a rather chastening experience. Another thing at that time, there isn't time for me to develop on the point today, we were transparent to a degree about the models that informed, that helped inform decision making. So it's not the case that you have a gigantic model, you press the button and it says, oh, inflation's going to be over target unless you tighten, or the opposite. So these only, they help your judgment, but there was going to be a lot of pressure on us to be transparent about the models. And we tried to get out in front of being forced by the Treasury Committee to do that. So we did that proactively. And I can assure you there's nothing like imminent transparency to concentrate the mind, to check that these are going to pass muster academically. So modelling is now much better than it was then, but this was an act of openness. Now, I left the committee in the autumn of 2000 to go on to the OFT job that Robin touched on. In the years following, of course, you had this gigantic event of the financial crisis of 2008-9. A lot of people said that shows that inflation targeting, which is the regime of monetary policy, our job was to choose the interest rate month by month to try and get close to the inflation target. That shows that this regime is not fit for purpose, doesn't work, banking system's a total mess. I think that's absolutely the wrong point. I think, in fact, the monetary policy regime worked perfectly well through that period, and it kept inflation expectations well anchored. The financial crisis was a gross failure of financial regulation, but that is a different point. So I would certainly not be with critics of the monetary policy regime on account of the financial crisis. But what it did, because it was such an enormous hit to demand in the economy, and there was this great expansion of fiscal policy and tremendous easing of monetary policy, meant that central banks around the world, which had been choosing interest rates in the 3, 4, 5, 6% area, depending on their local conditions, all went one foot on the floor and put their official interest rate down at or near zero. You can't go much below zero, because if you're getting minus 5%, as it were, on your bank account, you probably take the money out, stick it under the mattress or something of that kind. So this was the zero lower bound, which theorists had theorized about for a long time, was now an absolute practical reality. And instead of saying, well, should we be 5.25 or 5 or 4.75 this month, which had been the old sort of one-dimensional thing, we were now in different terrain, interest rate super low, and we entered the era of quantitative easing, where the policy instrument became instead the central bank printing money, as it were, electronically, in order to buy up mainly, but not only, government bonds, in an attempt partly to signal the future of monetary policy, low rates for longer, partly to try and depress longer term interest rates to encourage investment and discourage saving at a time when demand was very, very weak because of the calamitous effects of the financial crisis. Now, in Japan, you'd had this kind of policy, the zero lower bound biting, for years and years before. But in the European and US, Canada, and so on, this was new. So zero lower bound was biting and quantitative easing. Now, I spoke of the crisis of 2008-9. Beginning in the spring of 2010, we had the Eurozone crisis on top of that. So all the problems in Greece, Ireland, Portugal, and elsewhere. We had roughly a 2-year crisis period, which was pretty worrying. And even Italian and Spanish government bonds were yielding a lot more than their German equivalents in exactly the same currency, exactly the same maturity, signaling that the markets thought there was even some default risk on the government borrowings of those major economies. But we got through that period. And then here are some events from 2013 onwards. I'm dating it. That was when Mark Carney succeeded Mervyn King. And these are the things which I found in different ways puzzling. The first point is forward guidance. So this was the idea that the Monetary Policy Committee, instead of picking an interest rate or an amount of quantitative easing each month, should give much more of an indication to the public and to the markets about how it saw monetary policy developing. And this is a perfectly understandable ask of the bank, but how they responded to it, I remember on the day of the announcement being really quite surprised, because they, again by a majority, there was a dissenter, one of the externals, Martin Wheel, I think admirably dissented from that. Probably quite difficult to do with a new governor, but he did dissent. And the MPC stated an intention not to raise rates from near the floor until the unemployment rate had risen below 7%. Unemployment today is like 5.2. After the financial crisis, it was up in the sort of 8s and 9s. And this surprised me for a number of reasons. One is that the relationship between unemployment on the one hand and inflation on the other is totally unstable. So in the trade, this is called the Phillips curve, and it goes all over the place. So I thought it was very odd to pin monetary policy that's inflation targeted upon that real variable. It's not even a nominal variable, whereas the inflation rate is obviously annual rate of change of something nominal. The other thing that surprised me was the emphasis on one variable, because under both Eddie George, Mervyn King, and all of us on the committee at that time, we were very much pluralists, saying you've got to look at everything. There's no magic number that gives you the guidance as to what to do, not one magic variable. Now, the forward guidance that the bank issued then, it's not just that simple statement. It was hedged by lots of other words. So it would be wrong for you to think, I shouldn't imply that I'm picking out just one thing. But this was the centerpiece of it. And defenders of what they did said, well, look, we said we won't raise rates until the unemployment rate is lower. And as the unemployment rate went below 7, below 6, below 5, and they didn't do anything to rates, they said, look, you don't understand. There's a necessary condition, sufficient condition. This is a necessary condition, not a sufficient condition for a change in rates. But I think this was a mistake from the start, and they soon backed away from it partly because the unemployment inflation relationship really didn't stack up with that. And rates stayed low until they started raising basically at the very end of 2021. So that's puzzle one. The second point I want to touch on, and it's turned out to be quite timely. In 2015, the bank had an external review of its communications policy and other aspects of operation of the committee. And that review was done by Kevin Walsh, who is President Trump's nominee to chair the Federal Reserve. So he's very much back in the news. And some things that came out of his review, one very sensible one was to move away from a cycle of monthly meetings to every 6 weeks. So 8 meetings a year, unless there's a crisis, rather than 12. And I think that was definitely a good idea, because the monthly cycle, you're a hamster on the hamster wheel, and it's sort of never ending. You're starting the next policy cycle almost before you finish the last one. So I think this is definitely a good move. But in communications of policy, whereas we had been arguing away, not only right up to the policy decision, but about the minutes and so on, even afterwards, what they've done since the Walsh Review is publish the decision and the minutes and even the quarterly report every 3 months on the same day. So there's a super Thursday of publications. And I don't know what the committee dynamics are now, other than what's in the minutes, but it must be totally different from how it was when back at the end of the 90s, because there was no way in the world we could have produced the minutes until days afterwards. We were still arguing a couple of hours before the announcement. So it must be that they're doing more earlier in the cycle to adhere to this communications policy. It's definitely neater and in some way more professional. But I wonder if the vibrancy of debate, which wasn't always enjoyable to be part of, but I think was a very, very good thing. And I've been in my life on lots of committees. The risk of groupthink never goes to zero, but I think given who was on the committee that I was on, I think that was a pretty low risk. And I remember one occasion, a year before that photo, somebody called Alan Budd was on the committee. Once we were unanimous, which was like, oh my, what's gone wrong here? And he said, this makes me uneasy. He said, let us just assume that we are all wrong, and let's think what's the most likely reason why we are wrong. And I think that thought experiment is a really healthy one, even when you are all at one. Because in a way, it's nice to get everyone agreeing. You think, aha, everyone agrees, we must be right. And that remark I thought was a good antidote. Now, it's gone further. In the last few months, the minutes now have individual paragraphs for each member. So it would say, Robin Mason said blah, blah, blah. Now, for that to be in the minutes published at noon on the Thursday, Robin Mason must have written it, I thought, the night before at the latest. And I just wonder how much within meeting flexibility there is in a world where all this happens. So that, for me, it might sound a bit niche and a bit micro, but I think these committee dynamic points are really quite important. Another thing they did was to stop calling the inflation report, and they called it the monetary policy report. You get conservative with age. I was sorry they stopped calling it the inflation report, because I thought that title indicated that the focus was inflation, which was the prime focus. Now you say, yeah, but it is, but then there's all this other stuff too. But an interesting thing, which I'm sure Peter would have found amusing to troubling, is that you might think, well, okay, monetary policy report, there must be quite a lot about money in that if it's no longer called the inflation report. Actually, if you do a comparison, we in the old days had many more charts and tables and references to money and monetary aggregates and credit aggregates than the MPC did in a few years ago. It's got a little bit, they have a little bit more of it now. But money had almost got airbrushed out of what they were going to do at the very point when they started calling it the monetary policy report. None of us were, not even Charles Goodhart, were sort of monetarists, but we all thought there was important information in the monetary aggregates and how they were moving around. Next puzzle for me was the way, especially the governor, reacted to the Brexit referendum result. So on that question, I 100% agreed with the governor, but I was surprised that he made two quite high-profile speeches in the days following, including the remark that he thought that monetary policy should be eased in the light of that, which in effect meant more quantitative easing. I was doubly surprised, A, because I wasn't sure the other committee members would be too happy about the governor going out in that way. I think if Eddie George had done that, some of the members I was on the committee with would have had some pretty sharp things to say. Also, it wasn't immediately clear that the referendum result called for easing of monetary policy. Its most immediate effect, I remember watching this happen on the markets during that night, was that sterling dropped a lot. And that is inflationary, not deflationary. So it wasn't even clear in terms of direction which way you would go. But they did a whole load more quantitative easing, and they extended it beyond government bonds to some corporate bonds, which again makes me uneasy because the central bank, which corporation do we think is eligible? It's a bit picking and choosing among the private sector, which I don't think central banks ought to do. And then a couple of years later, they realized that some of the corporate bonds that they bought were not all impeccably green. So then they had a great program, gave a lot of speeches about greening the portfolio of bonds, which in my view, they shouldn't have bought in the first place, but there we are. Another puzzle for me was how they responded to the pandemic. So this is a slide from a talk I gave in my college community, so largely to non-economists, comparing, this was in the spring of 2020, the situation as it looked then in that very, very febrile, difficult, uncertain time to the financial crash of 2008. And I think a very clear difference is that the 2008 crash was demand in the economy falling off a cliff, but with no effect on most of the supply side. Car factories could still produce cars, restaurants could still serve meals, people could still go to offices, to schools, and all the rest of it. Whereas 2020, the latter all stopped happening on scale. So it was a huge supply shock. And when there's a supply shock and a demand shock, because clearly it was both, whether the net effect is going to be uppish or downish for inflationary pressure, I think ex ante is just not clear. I mean, it's highly uncertain, and again, soon we could go either way. But for the policy community is we must ease a lot more. So they, again, went in for a lot of quantitative easing. So this shows the different increments of quantitative easing. This is how many £billion worth of bonds the Bank of England had purchased with money that it created electronically. And the initial amount following the crisis of 8-9 was 200 billion. So in round numbers, the size of the economy then was about 2 trillion. So that was something like 10% of GDP, which in the Eurozone crisis years, they went up to 375. So we were in the high teens in terms of percent of GDP. Then we had, to my mind, the mysterious Brexit increment of another 70. And then in 2020, there was loads and loads and loads more, taking us up to nearly 900 billion. Now, the economy had grown over that period, but even so, this was putting us up in the region of 40% of GDP was what the Bank of England balance sheet was. So huge amounts of quantitative easing. Now, did this do good or did it do harm? I think the early years QE did good. I think it supported the economy and stopped inflation going further below target at a time when it needed it. I think it did lower interest rates to some extent, but I believe this is an area where you've got really quite significant diminishing returns the more and more that you do. Because the signaling benefit, I think you've largely had. And when interest rates were near the floor, then, including for long-term bonds, they were very low in yields, like 1 or 2%. Then printing money that's yielding 0.5% to buy bonds, longer-term bonds that are yielding 1 or 2%, is going to have much less effect than printing the money to buy bonds yielding 4, 5, 6%. And a sort of feisty way that Stanford economist John Cochrane has put this is that you're basically just shuffling about bits of government paper here. It's like a dietitian saying, you really got to do something about your diet. I'm going to take away your red M&Ms and replace them with green M&Ms. It's not going to make any difference at all except to the color scheme. There is lurking in that example, by the way, a highly intellectual joke, because those of you doing finance will have heard of the Modigliani-Miller theorem. So he chooses M&Ms to make his point in those terms. So his view is that the effect of this policy is kind of zero through the teens. He's talking mainly about the US, but the point would extend. And he's saying this is one of the great non-events. A lot of people, when they saw this money creation, the old-style monetarists would say, oh, we're going to have terrible inflation. Some of the old-style Keynesians would have said, you know, we're going to have prices spiraling down. He said, look, through this period, through the teens, nothing happened to inflation. It just ticked along in low single digits. We saw consistent with the idea of not much effect. Now, whether I buy this or not, I'm not entirely sure, but it's a sharp way of putting the point about diminishing returns. However, one thing you do if you print a load of money to buy up long-term bonds is you expose the public sector to fiscal risk. Because if I'm the Bank of England and I bought a load of bonds in 2020 yielding, long-term bonds yielding 1%, and then interest rates change, and now the long-term bond yield is 4 or 5%, then I incurred a massive capital loss. And never mind the detail, but the broad brush of this chart is saying that this operation, it was done for reasons of market functioning and inflation control. It wasn't done to make money. Up to 2021, it was really quite profitable for the bank because it was getting, let's call it 2% interest and paying out 0.5% in interest. So it was getting a nice chunky spread. But then when interest rates picked up in 21 and particularly in 22, and they've stayed much higher, there's now an enormous loss that the Bank of England has incurred for the public sector. And the best current estimates, it can swing around because these numbers can change. Order of magnitude, it's looking like an overall loss of perhaps minus 100 billion. And it sounds a lot, it is a lot. Similar story in other economies, but the accounting that we do is much more transparent than some other central banks. So this is kind of a vivid thing. So in a way, you're taking a fiscal gamble if you do this, or a side effect of what you're doing is there can be a big swing, plus or minus, in terms of fiscal cost. And at the moment, it's looking very costly. And given the wider fiscal policy situation in this country, that's clearly not great. Now, what about the inflation surge? And I'll conclude with this and leave a little bit of time for Q&A. So having chugged along not only since 97, but since about 1993, with low and stable inflation. Remember that ideal blob on the very first chart, 2% inflation, very low and stable. We had in 2021 this huge increase up and above double figures inflation rates. So what is going on there? How did we have out of this pretty calm sea, even through the financial crisis with little waves going up and down, warmth of inflation? And it came down during 23 and 24, but it's still, we have inflation for most of the subsequent period significantly above target. So we've been today we're 3.0, today's number, but we were in the upper threes until then. Remember that one of the earlier charts said that from 1997 to 2007, the governor of the bank never had to write a letter to the chancellor saying, we have missed the inflation target by more than 1%. The regime is the governor has to write such a letter if there's a miss of more than 1%. That didn't happen for nearly 10 years. So nearly 120 times the number was within the 1%, plus or minus 1% corridor. But we've been outside that corridor even after the decline in inflation recently. So I think a very interesting and in some ways, I think, open question is, what on earth happened there? Now, to make the same point in a slightly different way, if you go from 97 until spring of 21, the price level in this country rose 60%. If 2% inflation targeting had been perfect, it would have risen about 60%. So it's not only that inflation rates, it's even the price level incredibly close to what you would have. And that's partly what I mean by the luck of the older regime. Whereas in the last 4.5 years, the price level is up about 26%, and it should have been up 9%, 4.5 times 2. So we've had an overshoot of 15% plus plus. Similar in the US, about 13% is the number I've seen there. And that's a really big overshoot. Now, it's obviously to do with the pandemic, but pandemics on their own don't cause that. So it's something about economic policy relating to the pandemic. So what happened with the pandemic was an enormous expansion of fiscal policy. In this country, in other countries, in the US, you had the first Trump administration, and then you had the Biden, curiously named Inflation Reduction Act. Again, lots of expansionary fiscal policy. And central banks through 2021 kept interest rates down at the floor. And a lot of us were thinking, why don't they start raising rates? Not least for their reputation, because inflation was visibly building. And I remember seeing the current governor, give a speech September 21. And I couldn't believe how it seemed to be very, very dovish. And there are a number of the old lags like me at that dinner. And one was going around saying to former committee members, what do you think they should be doing? And apparently we all thought they should be tightening by then. But that only started, I think, in December of 2021. And then they went up this staircase of interest rate up into the fives, likewise with the Fed. European interest rates a little bit lower. And then in the last year or so, we've been on a sort of gentle staircase down. And there's lots of speculation about whether at the next meeting, Bank of England Monetary Policy Committee will go down from 3 3/4 to 3.5. And I don't know. Depends on the data that will come out in between. But it felt to me they were slow to tighten. And that's certainly not just my view. There's a Economic Affairs Committee in the House of Lords is super impressive. And they were looking at quantitative easing and the rest. And that quotation is from a report that they made in July of 2021. So this wasn't when it was sort of flashing lights 2022 and 3. Now you might say, well, it's not only the pandemic, you had the Russian invasion of Ukraine, what that did to energy prices, but just, oh no, hang on, that's coming, sorry, 2 slides back, I think. Yeah, so the little purpley bits there, if you can see them, that's the like accounting measure of the energy price effect, upwards and then downwards on the inflation rate. And clearly that was unhelpful for inflation. But the surge we had cannot possibly be fully explained. I think it's not even half explained by what was going on there with energy prices. I think what happened was that you had this incredibly expansionary fiscal policy and incredibly expansionary maintenance of very, very expansionary monetary policy and a load of supply constraints. And when demand exceeds supply at prevailing prices, then prevailing prices go up. I think it's essentially that. And a number of voices on both sides of the Atlantic have been making that point. Now, recently, in 2024, former Fed Chair Ben Bernanke did a review of models at the Bank of England. Now, 25 years earlier, we'd published the suite of models in that little blue book I showed earlier. He identified a number of, from the outside, what looked like quite serious problems with the central model used by the Bank of England for monetary policy purposes, including an assumption that inflation reverts to its 2% target. And one of the puzzles about why all their forecasts seemed to show inflation coming down to 2% very neatly. If those forecasts were produced by a model with that property, then it's less mysterious as to why that was happening. So there's been a big exercise in the last 18 months to try and revamp the modeling framework at the Bank of England to support policy better. So I will wrap there to leave 5 minutes, just with a few remarks. There is no question at all that the job that policymakers have now, after the financial crisis, the pandemic, the much more strained fiscal situation, geopolitics, the world trading environment not being what we thought it was going to be, it's formidably difficult compared with the relatively calm period which the early days Monetary Policy Committee had. Moreover, we were the creation and, in a sense, the baby of Gordon Brown. So the political pressure on us was zero, because he said independent monetary policy and we were totally protected politically. I think it's got much more choppy politically now, and was bound to do so in the era when you're moving into quantitative easing, where monetary and fiscal policy get intertwined in a way that wasn't so much the case earlier. I wish that there was, in speeches and so on, a sharper focus on inflation controlled by the bank. We went on and on about that. People called us inflation nutters, which I don't think was justified, but we were very keen to get inflation expectations in the right place. And I think it's extremely important that after this turbulent period and the big inflation overshoot, that monetary and with it supportive fiscal policy does the same in the UK. And the key prize then is to retain the asset of institutional credibility for the Bank of England doing monetary policy, which from the 1930s to the 1990s, we were really poor at inflation control in this country. And we finally got a grip on it. And let's hope after the recent inflation surge, we can lock that down again. Thank you.
Is there another question? Each? I was just my name is Aditya Goenka. I'm a professor of economics at the department. I was thinking about your characterization of how monetary policy has changed and the big quantitative easings we've seen in recent years. I wonder if that reflects the thinking about monetary policy and economics. So let me elaborate. When I taught monetary economics in the mid-90s, we looked at a whole suite of models, and by and large, we were coming up with some kind of rule for money growth. But now, the way monetary policy is taught, it is in the new Keynesian framework, where there's so much focus on the output gap. So it's also the way in which we think about monetary policy has changed pretty much entirely over the 25 years. And what you're describing, is it a change in thinking monetary policy amongst economists, or is it something else?
Right. Well, I certainly agree. I mean, in the 80s in this country, we had the Thatcher government, and we're in the Alan Walters building, aren't we? So monetarism, which I think didn't work, partly because you can't control the money supply. And I think it doesn't work in theory either. So that was discredited. We then had trying to hold on to the exchange rate mechanism, Deutschmark pegging and all that. That didn't work, and we had 1992, after which inflation targeting wheeled in. I think the consensus view academically, I think of Mike Woodford's 2001 book, his sort of treatise, that was the marriage of rational expectations with New Keynesian. And it is output gappery, a lot of it. The monetary stuff is almost like a residual. You look in the footnote or the annex to see what's happening to the money things. It assumes that the monetary authority is the boss, and it's monetary policy dominance over fiscal policy. And I think that has come into question. But theoretically, this feels to me quite kind of open at the moment. And although I'm not yet persuaded by it, John Cochrane, who I mentioned with his fiscal theory of the price level, I think that's pretty interesting. And if you want a succinct account of that, he's got this great book called The Fiscal I mean, large and interesting in other ways book, which is, I don't know, 500-600 pages, but he's just put on his website a few days ago an 80-page book on inflation, which is a sort of summary of that based on some lectures he gave very recently in Switzerland, the Brunner lectures. And I think a lot feels kind of open at the moment. And the Woodford settlement, and I'm thinking of Lars Svensson and people like that, and we thought in terms pretty much like that. I remember joking with Willem Bouter, what's the nominal anchor? This is sort of jargon of non-economists. And our joke was it's P naught. You know, it's what the price level was a year. That's what we're moving from. But I recommend if you want a bracing and challenging, in some ways unsettling read, try John Cochrane.
We have one question from Zoom, which I'll take before we go to the next one in the room, is how would you comment on Walsh's lower rates and expanding Fed's balance sheet?
Sorry, on his lower...
On lower rates and expanding Fed's balance sheet.
Well, I don't know enough about what Kevin Walsh has said. Where I have, and it will come through from this, some sympathy with what I've seen him reported as saying. I do think central bank balance sheets got too big. And yeah, I thought, fine, the 375 billion 2009 to 12 in the UK's case. But when that was, more than doubled, Brexit and the pandemic, it was partly to restore market functioning. But you think, do you need that much? And even if you do, when the market's working again, why don't you suck it back? So I think the balance sheets did get too big. I'm also with him on his kind of, or reports of focus on the basics. I think there was, just look at the topics on which speeches were given by Fed officials and Bank of England officials. I think quite a lot of that strayed away from the core task. So my last slide was about back to basics. Now, on the level of the federal funds rate, I have no view at all. Not that I have a view I don't want to share, I just don't have a view. So.
Hello, I'm John Fender. I'm an emeritus professor in the economics department. Two quick questions, if I may. First of all, you mentioned the payment of interest on reserves, on bank deposits at the Bank of England, which are going to be very expensive over the next few years. There have been some proposals to change the way in which interest is paid on deposits. I believe a certain political party has advocated abolishing them, and there are other proposals out there for some sort of tiered system. Would you have any thoughts on whether we should change the way in which interest is paid on deposits at the Bank of England? That's the first question. And secondly, does the concept of core inflation have any validity? Sometimes it's argued that what matters is core inflation, that there are a lot of transitory elements of inflation, and we really shouldn't bother about those, that it's some sort of underlying fundamental rate of inflation which we should target. So do you have any views on that? Thank you.
Thank you very much. So on the second question, at each monthly release, the first thing I look at after the headline is core inflation, because I think as an indicator, I think it, a lot of these transitory things about energy prices and the rest can throw the headline numbers up and down. However, I would not make it the target. So I think it's a highly informative thing, but the moving away from the headline measure, I think in terms of public understanding about what's going on, that's not a move I would make. Incidentally, the target did change between 25 years ago and I can't remember which year it was, in the mid-noughties. Our measure was inflation under the RPIX measure, which is Retail Prices Index, excluding housing costs, whereas now it's CPI. And when that change was made, the target went from 2.5 down to 2. Because of the maths of index construction, the wedge between the two is probably, on average, more than 0.5%. So, but it's in that ballpark. Now, interest on reserves, I think, is a very interesting question, Paul Tucker, in a piece in some IFS volume a couple of years ago, spoke favorably about going to a tiered system. So you'd be paying interest on marginal reserves so you could make the policy rate stick in the markets, but you wouldn't be remunerating all these hundreds of billions of reserves at the central bank that the commercial banks have. And all those charts about the loss on quantitative easing, prospective loss as it currently looks, but as I said, it could change. That will be very different in that regime. Paul Tucker's not the only former official who's spoken in those terms. As you say, the Reform Party embraced this idea. I'm agnostic. In a way, it's a tax measure, but then all taxes have inefficiencies. And we have a government that made manifesto commitments that may make some tax instruments locked away. So it's not, one can't rule out that this would be a policy with some merit, but I am not a signed up supporter of it. That's equivocal, but that reflects my, my feelings about it.
One more?
Thank you. My name is David Evans. I'm part of the research division here at the university. Given the large revision in US jobs numbers that were released last week, do you have any reflections on the quality of data that's available to decision makers at the moment?
Only the point that everybody's making. We've had tremendous problems with ONS data, particularly on the labour market. And it's partly that response rates to all these surveys have declined hugely. And I think that's a real problem. I mean, we were, back in the day, we were looking at everything. We had big data packs. We had that all day on the Friday briefing, went through, we had packs with hundreds of charts on all sorts of measures, some more important than others. But if the quality of those diminishes, you're in trouble. We actually had a particular problem with the wage inflation data at the end of the 90s. And it turned out that there were some real problems with the way that was constructed. And that was a very important number for policy because we were concerned about domestically generated inflation. That is, ignoring the then downward effect that import prices were bringing. So wage inflation, you'd think, well, wage inflation minus labor productivity growth, that might be it's not like a measure of core inflation, but it seems pretty relevant. But if you've got aberrant, over volatile numbers, and Martin Wheel, who I was later on the committee and was the dissenter from Forward Guidance in 2013, he did a review of that, all public. So we had a little bit of that problem, but it seems to have gone much wider now. And it's a real problem because the data must, that's the only basis on which these judgments can properly be made.
Hello, Jane Binner, Chair of Finance in the Birmingham Business School. Thank you for an excellent presentation, outstanding. I wanted to pick up on the comment you made about money not being mentioned as much as it used to be. I mean, I'd say, a prominent scholar working in the Barnett critique and a follower. I don't know if you've heard of the Ed Nelson paper who put the M back into monetary policy. I wondered if you've got I should say I've been lucky enough to be selected to present at the monetary policy meeting in the Bank of England on the 4th of March. And that's my paper on Divisier user costs. Have you got any comment to make on the Divisier index measure of the money supply and talking about data measurement, actually measuring the money supply and the user costs correctly, please? Thank you.
Thank you. So the short answer is no, I don't have a comment on the Divisier. I just haven't thought enough about it, not just recently, but probably ever, to give a good answer to that. Ed Nelson was at the bank when I was there, but I don't know the paper of his that you refer to. And he was doing, I mean, lots of great work with McCullum. There are a lot of papers involving the pair of them. I mean, when I said we looked at the various monetary aggregates, seriously, and especially with Charles Goodhart on the committee, you couldn't get away with not doing that. And I think we all very much wanted to do that. I never read the then governor or Mervyn King as monetarist, but I think their view would be, look, we have, the statute gives us a target to try and control a nominal variable, so it's in money terms. We have to understand this inside out, and all the credit numbers that are the other side of bank balance sheets. But one of the powerful points I think that Cochrane makes with the fiscal theory of the price level is, he in short is saying you need to think about money and bonds jointly. They're all liabilities of the state. I don't mean all money, I mean government money, not commercial bank created money. And especially when you have an era of very low interest rates, which we had from 2009 to 2021, low interest rates all the way along the yield curve, the difference between money and bonds is much less of a difference than in the old days when you might have money yielding. When I went up the stairs to tutorials with Peter, we probably had money yielding 0 and bonds yielding 10%. And I remember doing Baumol and Tobin and all these people on money demand. But we've been in a very different world. So he's saying think of the two very, very much more together. I mean, it sounds good that they're getting you in because they seem to be showing more interest in money aggregates than they were 3 or 4 years ago, where I think it did seem to fade from view in terms of their communications at any rate. So it sounds good fun. Yes.
Yeah, it just remains for us to thank Sir John for a wonderful talk and extremely thought-provoking.